Welcome to Breaking News to Trading Moves. We have a very focused analysis for you today. We're looking at a single high-profile political endorsement in the U.S. semiconductor industry. Our goal here is to examine the event, the market's reaction, and, well, the list of winners and losers that emerged from it all. So the headline event that got this all started was a meeting between President Trump and Intel CEO Lip-Bu. After that meeting, the president posted about a great meeting, and then he added a very specific line. He said the U.S. government is proud to be an Intel shareholder. And that's really the action we're looking at.
And the market responded almost instantly. That statement was taken as a very strong policy backing. Intel shares, that's INTC, they jumped about 10%.
Wow.
Yeah, it pushed the stock to its highest point in nearly 2 years. But it wasn't just Intel. We saw other chip stocks move up right after that post came out.
Right. So we're not just looking at a reaction to a single comment. We have to consider the context here. This didn't just happen out of nowhere, did it?
No, not at all. The backdrop is this existing relationship. The U.S. government had already taken a 10% stake in Intel last year?
So this new public statement feels more like a doubling down on an existing commitment.
That's a perfect way to put it. You have the existing investment and then this very public support. That combination really affects market sentiment. And it's especially important for a company like Intel, which is in the middle of this very complex and capital-intensive turnaround strategy.
So investors aren't just reacting to a meeting. They're seeing this as a confirmation of stability for Intel's manufacturing plans.
Precisely. The market is reading that dual confirmation, the public support and the existing stake, as a real vote of confidence. It signals that their big spending plans, especially for building new fabs here in the U.S., are probably safe from any policy changes.
And that stability is what attracts the big institutional money.
Absolutely. And we saw that optimism spread pretty quickly across the whole tech sector. The move in Intel added energy to a rally that was, already being led by general optimism in tech.
Okay, let's look at the financial consequences then. Who benefited from this burst of optimism? The analysis breaks it down into three distinct groups of companies that gained momentum. Let's start with the most obvious one.
Group 1 is, of course, Intel and its direct peers among U.S. chip makers. They get what traders call a momentum bid. When news like this drops, it reinforces that domestic policy support, and that can pull in momentum traders. You get analyst upgrades and large index flows.
And those flows tend to go to the big names.
They do. They favor the large cap U.S. semiconductor stocks. So Intel, INTC is the main one. But we also saw another major player, Advanced Micro Devices, or AMD, catch that initial wave.
Okay, that AMD name is one we're going to have to circle back to because of their competition with Intel. But let's stay on the positive side for a moment. The next group that saw a lift was the AI and data center leaders. We're talking about giants like NVIDIA, NVDA, and Broadcom, AVGO. Why do they get a boost just because Intel had a good meeting?
It's really about herd behavior and portfolio mechanics. When the whole semiconductor sector rallies, especially when a massive stock like Intel leads the way, a couple of things happen.
Okay.
First, the sector ETFs, the exchange-traded funds that hold baskets of these stocks, they just automatically have to buy more of everything. So NVIDIA and Broadcom benefit just by being in the basket.
So it's almost an automatic lift.
It is. And second, you just get a general rotation of what they call risk-on capital. Investors see the sector as safer or ready to grow, so they put money into the established leaders, even if they weren't the cause of the news.
And NVIDIA and Broadcom are the undisputed leaders in AI and data centers.
Exactly. So they benefit from that general sector-wide optimism.
That makes sense. Okay, finally, let's look at Group 3, the infrastructure players. Some people call these the pick and shovel companies. These are the ones selling the heavy machinery like Applied Materials, AMAT, and Lam Research, LRCX.
This is a classic secondary effect. It's driven purely by the expectation of more capital expenditure, or CapEx. Intel's whole turnaround plan depends on building these enormous new fabrication facilities, these fabs.
Right, which cost billions.
Billions of dollars on specialized equipment. So if investors believe Intel now has the policy backing to actually execute this plan, they immediately start pricing in higher orders for the toolmakers.
So you're saying a company like Applied Materials, their stock was up today because of orders they might get next year?
That's it, exactly. Applied Materials and Lam Research, they provide the highly specialized equipment that goes into a clean room. These tools are essential and incredibly expensive. Any belief that a giant like Intel is about to speed up its spending, well, that basically guarantees a revenue stream for the toolmakers for years to come. That forecast is what drives AMAT and LRCX higher.
So the winners seemed clear. Intel, the sector leaders who get pulled up with them, and the equipment suppliers who expect future orders. But in a competitive market like this, there's always another side to the story. Where did the market see pressure building?
And that takes us to the other side of the ledger, the companies that were identified as facing some headwinds from this. Group 1 is what we can call the CPU share takers. This includes Advanced Micro Devices, AMD, and Qualcomm QCOM.
Wait, okay, so now we have to address it. AMD was on the winners list, and now it's on the losers list. How can the same company be in both groups at the same time? What does that tell you about how the market is thinking?
It tells you that the market is thinking in two different ways at once. It's tactical. The reason AMD, trading as AMD, is on the winners list is straightforward. It's a large-cap U.S. semiconductor stock. The ETF flows lift the whole group. That's a momentum trade.
A rising tide lifts all boats, so to speak.
For a moment, yes. But on the losers list, we're looking at the competitive outlook, specifically for their core business, which is CPUs, central processing units.
And they go head-to-head with Intel there.
They are the primary rivals in PCs and servers. So if the market now believes that Intel, with all this backing, is stabilizing its business, investing in new tech, and maybe even going to regain market share, then AMD's competitive edge looks a little less sharp. So maybe the whole sector goes up 5%, but Intel goes up 10%, and AMD only goes up 4%. In that case, AMD is the relative loser because its valuation premium starts to shrink.
I see. And Qualcomm?
Qualcomm, QCOM, faces similar pressure. They're big in mobile processors, but are also pushing into servers. A stronger incumbent in Intel makes that push harder for them, too.
That distinction is really clear. Short-term capital flow versus the long-term competitive view. Okay, let's move to Group 2. This one is about companies that rely on offshore foundries, specifically Taiwan Semiconductor, or TSM, and United Microelectronics, UMC.
Here the key ideas are geographic exposure and this idea of a domestic champion. TSM and UMC, they trade in the U.S. as ADRs, which just lets U.S. investors buy shares in overseas companies. So when you have this very public endorsement of a U.S.-based manufacturer like Intel, it tends to drive capital away from companies whose manufacturing is concentrated overseas, especially when there are perceived geopolitical risks in those regions.
So investors focused on supply chain safety might see this as a signal to favor U.S.-based manufacturing stories.
That's a big part of it. They might see it as aligning their portfolio with U.S. policy priorities. It's a move away from the offshore foundry model toward the domestic one.
And finally, Group 3. This involves a potential squeeze on the companies at the very end of the line. The PC and device makers, the OEMs. We're talking about companies like Dell, DELL, and HP, HPQ. How do they get hurt if the chip sector is doing well?
It all comes down to leverage and margins. Dell and HP have to buy their main components, especially CPUs, from suppliers like Intel. If the market believes that Intel's negotiating position just got stronger, thanks to this government backing, then the OEMs could face higher component costs down the road.
Ah, so Intel's strength becomes Dell's problem.
Potentially. When Intel is seen as politically stable and strategically crucial, its bargaining power goes up. That might let them hold prices steady or even raise them on key components. And since OEMs like Dell and HP already operate on pretty thin margins, any increase in their costs goes right to their bottom line. It could squeeze their profitability.
So we've traced the effects of one meeting and one public post all the way through the tech supply chain. We saw the immediate capital going to the main player, INTC, the sector leaders like NVDA, and the upstream toolmakers like AMAT. But at the same time, there's competitive pressure on rivals like AMD and QCOM and margin risk for customers like DELL and HPQ.
And that really highlights a core concept for you to think about, financial asymmetry. When a policy move strengthens one company, in this case Intel, INTC, it doesn't create one simple benefit. It creates these complex opposing forces. It helps their indirect suppliers like Applied Materials, AMAT, but at the same time it puts pressure on direct competitors and can squeeze their key customers.
It's a perfect example of how one piece of news can translate into very different trading moves across the market. Thank you for joining us.
And please remember that this discussion is based purely on the information provided by the author of the material reviewed. This is not financial advice, nor is it a recommendation to buy or sell any security. It's purely the opinion of the author of the analyzed content.